Hey, it's Stuart. You know, the reality is everyone wants a 10% return, but no one wants the rocky road that goes with it. And unfortunately, volatility is normal. 2/3 of the time, your return in the share market is likely to be between minus 10% and a positive 30%. That's a 40% range. And 90% of the time, it's going to be somewhere between a loss of 30% or a gain of 50%. Again, it's a huge range and it sort of demonstrates what volatility looks like. But the problem is, or the challenge is, everyone understands what the average return looks like. The only problem is you never really receive the average return. So between 1986 and 2025, the S&P 500, the US index, returned about 11.5%. However, only 3 out of those 40 years did the return lie between 9 and 12%. So the average return, or close to it, was only enjoyed 3 out of 40 years. The rest of the time it was outside of those ranges. And you know, another interesting statistic is the average intra-year decline is around 14%, which means at some point during the year, an index is going to be down, and this is the S&P 500, is down 14%. But 75 or more than 75% of the time, in a period where the average intra-year decline is 14%, 75% of the time, the year ends up being a positive return. So these wild swings aren't unusual. They're a normal part of investing. They're the price of entry, if you like, the ticket to the dance. Drawdowns of 30% or more will happen multiple times over our investment lifetime, and we just have to expect it. The problem is you can't really plan for it, because by definition, a market crash, like a 30% decline, typically happens because something is unexpected. By definition, the thing that's going to crash the market next time, and definitely will happen, of course, we know it's going to happen, we just don't know when, will be a complete surprise. Always is. You know, if you think about the GFC, once in a lifetime event, COVID, a global pandemic, once in a lifetime event. These things are unusual. You know, they don't repeat. They might be a once in a lifetime event, but they happen regularly, every 7 or so years. Now, the problem is you can't predict them. Philip Tetlock did an analysis and looked at over 28,000 predictions from 284 experts over 20 years. And on average, they barely beat the toss of a coin. And the more famous the expert, the worse they were at forecasting. So the reality is that we've just got to, our starting assumption has to be no one knows. You can't predict the future. You can't predict what markets will do in the short term. Returns are completely random. Over the long run, fundamentals drive return. Over the long run, if we're looking over a 20 or 30 year term, investment returns are relatively predictable. But over the next 2 months or 2 years, really difficult to predict. And that's why the best thing to do is keep a long-term horizon. The goal is how to maximize returns over 10, 20, 30 years. It's not a 12-month decision. So as I've always said, the best question you ask yourself is, what can I do today? Where can I invest? So that 10, 20 years from now, I'll look back at 2026 and go, that was a good decision, irrespective of volatility. And of course, volatility only becomes a permanent loss if you actually react to it. So if we know volatility is normal, we then know that if we make an investment today, the probability is in 3 or 6 months' time, we could be in a loss position. That is normal. That's not a failure. That's not your investment not doing well. That's the market behaving as you should expect it. And if you're in a profit position 6 months from now, well, that's great, but don't put too much weight on it. It's not because you've outsmarted the market. The market in the short term has just moved in your favor. And this is the foundation of rule number 1, which is thinking decades, not days. So if you would like to learn more, have a look at, there's a couple of links in the comment section of this video to an article which I sort of compare Investopoly to Wealth by Design. A link to have a look at the reviews on Amazon. I think we've got 19 or 20 reviews only after the first month, which is great to get that feedback. And if you've read the book and you like the book, please leave a review on Amazon. And of course, if you want to listen to more of these videos or watch more of these videos, please subscribe to our YouTube channel. Thanks a lot.